Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Mark Hackett, Chief of Investment Research at Nationwide, Anthony Woodside, Head of Investment Strategy at LGIM America, Scott Chronert, Head of U.S. Equity Strategy at Citigroup, and Jon Maier, Chief ETF Strategist at JP Morgan Asset Management. We're here to discuss the direction of the U.S. economy and implications to consider in a higher for longer rate and inflation environment. Gentlemen, it's great to have you here. Welcome to Trade Talks. Good to see some familiar faces here. And Mark, let's talk about this, the current state of play and returning to normalization within the market.
Yeah, it's been a really interesting, period, certainly since the pandemic, but also since last October. Contrarianism really has been the only real winning strategy in the market since the pandemic began. We noticed obviously tremendous amount of pessimism last fall. That switched to arguably some degree of complacency as we got through March. Really the things that we noticed was the market wasn't reacting the same way to things like rates, the Fed, inflation higher than expectation. You had this good news being good news and bad news being bad news. That gave us a little bit of nervousness as we got through March. That largely got taken out in April. So at that point, we've seen the zigzag pattern where the market really is seeking some degree of direction. I don't think you're going to get that for some time here, simply because we're learning how this new world acts. What we have seen, I think, that is encouraging is a little bit of democratization of returns, less reliance on the large technology names, a little bit more international small caps. Those types of things are starting to work, which I think is sustainable.
Mm-hmm. And Scott, really the question is perhaps the 10 to 12 year period prior to COVID was the anomaly where we were in this zero interest rate environment. Perhaps, that's what stands out when you look at it historically.
I mean, the way we're talking about it is that we think we're in a new paradigm it's kind of emanated from COVID as we've kind of navigated supply chain constraints from a global perspective. That's led to some of the inflation dynamic that in turn has led to the Fed response. And I think the setup from our approach is that we have to be prepared to acknowledge that it is a different world and a different paradigm than what we're living in the post-GFC timeframe, where the Fed, for a number of years, by virtue of either interest rate or QE trends, was trying to stimulate growth and stimulate inflation, and for the most part, unsuccessfully so. Mm-hmm. Right? And that had in our view, very important consequences that actually comes back to the rise of the Mag 7. During that time frame, those companies demonstrated outsized earnings growth relative to the rest of the market, which made life in many ways difficult for a traditional active manager. But at the same time, what it also did was, in a low interest rate environment, gave room for valuations to expand. And you are where we are today, where the Mag 7 are 30% of the index and 20% of the index earnings.
Yeah. Well, and Anthony, you had noted this too. It's really staggering to observe how consensus really evolved in just 18 months.
Sure. I mean, if we jog our memory back to early 2023, for example, basically economists and investors they were aligned in this view that the U.S. economy would head into recession under the weight of restrictive monetary policy. Fast forward to Q4 of last year, you essentially saw the hard landing camp start to retreat. And I think it was turbocharged by what we saw from the Fed. We saw a pivot in the Fed rhetoric, and essentially the Fed was suggesting that the cutting cycle was imminent here. Just to put some context, some numbers behind it, if you look at recently as January, you had about 170 basis points of cuts priced into the market, mm-hmm. versus what the Fed was pointing to of 75 basis points of cuts. What we've seen so far this year is, even though growth has remained robust, we still see inflation being more sticky than anticipated, and that's why you've seen basically cumulative cuts basically reducing from the 170 basis points to now less than 2 cuts this year.
Yeah, so Jon, would you say that the likelihood of a Fed hike or even a cut, is it priced out now? Perhaps nothing happens in 2020?
Excuse me, it's possible you'll see one in December and maybe into 2025. The Fed has made mistakes in the past, and they want to get this right. They want to make sure they've squashed inflation. They got some decent news this past week on, bad news is good news on the labor market, but that's just one data point. But the market really rallied based on comments from Powell that basically the rate hiking cycle is over. We don't know when it's going to be cut, December 2025, but it's likely not going up. So I think that was really important to the overall market. I think that, to your point earlier, quality is an area that I think still makes a lot of sense. We're in a high interest rate environment, and companies that are less reliant on the capital markets have strong cash flows and are increasing dividends, like Google and Meta. Those companies are benefiting, and those quality companies, I think, will take us through. And we are seeing some broadening out as well.
Yeah, well, I also think too, the challenge for the Fed as well, Scott, is the labor market does remain strong. Yes, it's coming a bit. The consumer, it's been really hard to bet against the consumer, despite a lot of the headwinds that the market potentially thought could have been issues for them.
Yeah, I think we're living in a world of unintended consequences, and Fed policy is one of those. I mean, if you look at the way we think about the S&P 500, it sort of defines Wall Street, but we think the Fed's actions are pointed at Main Street. And Wall Street, the S&P 500 fundamentally does not reflect what's happened to Main Street. Right. What you have is this bifurcated situation between, let's call it those with savings and those without. So if you're living paycheck to paycheck, you felt the effect of rising inflation and now higher rates on top of that. It's a pretty tricky situation. So you're seeing some fraying around the edges, that lower end consumer. But if you have savings, hey, you're earning income on your money market funds now. Mm-hmm. It's a little bit different story, particularly if you've locked in a lower rate mortgage over the past several years. So in the corporate America, it's the same thing. You've got those companies that are sort of lower debt, higher cash flow, higher free cash flow generating, versus those that have more significant maturity cliffs coming up in the next couple of years. The Fed policy action is having sort of different effects across the market that way as well.
Yeah, I mean, Mark, to your point earlier, where it's, is this a new normal or not? The fact that you can have an interest rate that's sub 3% on your mortgage and you're earning 4.5% to 5% on your money market. I mean, if you had that chunk of cash there, you could potentially pay your mortgage payments with the interest that you're earning. I mean, that doesn't happen much in economic and market cycles.
Yeah, this is obviously a very strange cycle on a number of ways. One of them is going back to my contrarianism is, you started about 18 months ago with the market just feeling that the Fed are a bunch of buffoons. We had the whole transitory inflation saga, and we've gone very quickly from that to almost an infallibility approach where the Fed's going to land this plane and we're going to have no landing and everything's going to be great. Truth's obviously somewhere in between, but my fear is the market isn't reacting to some of the Fed policy initiatives the way it would have in previous cycles. So we're not seeing the reaction to higher rates. We're not seeing the reaction to higher low or short or long-term rates the way we have in the past. And the question I have is that a sign that maybe the Fed's efficacy with their policy is no longer the same as it was in previous cycles? Or is this an anomaly? We obviously know a lot of the canaries in the coal mine traditionally that have really triggered recessions, whether that's the inverted yield curve, whether that's leading economic indicators, signaling a recession, they just haven't worked.
Right.
And I think the fiscal and monetary stimulus, the unusual nature of the pandemic, but also perhaps this gradual shift from a manufacturing economy to a service-based economy might make Fed policy less efficacious, which I think scares all of us.
And to another point about the housing market, it's so unusual because a normal housing market, people retire, they move to other places, they sell their homes. But because of these low interest rates, they're staying in their homes, and it's causing an imbalance in the housing market. So housing prices continue to go up despite 6.5%, 7% mortgage rates. Mm-hmm. And younger folks are completely priced out of the market. And I think one of the reasons the consumer is really holding up is because there's a segment of the population that has said, I can't afford a house, maybe ever, or at least not in the next 5 years. I'm going to go on vacations, I'm going to go out to eat, I'm going to have fun, and that's going right into the economy. But there are signs that that's weakening, particularly on the lower end, where credit card balances are increasing, savings rates are declining. So.
Right, but here's the whole thing. We know rents are going higher because people can't afford homes, but even if the Fed were to take it down, let's call it 3 or 4 cuts this year, right? Like you get some Goldilocks scenario. That's not going to make rents lower. It's not going to take down insurance costs are 22 to 25% higher in home insurance and auto insurance. It's sticker shock opening up your insurance premiums this year. That's not going to make a difference. That's specific to what's happening within that industry, not the Fed taking it down 25 bips.
Yeah, I mean, I think that's a fair point. I do think it might open up the housing market a little bit to the sense that You may have homeowners that feel locked in with their low mortgage rates. If the Fed reduces by 100 basis points, you might see some supply come back to the market. So for example, if you looked at existing home sales last year, it was pretty muted. A lot of that is the locked-in effect that was already described. I do think if we see some loosening, but it has to be more than just the 1-2 cuts priced in. It has to be more of a 100 to 150 basis points. You might see supply come back from existing home sales. That could potentially lower prices in the housing market. But that's something that seems to be a long way away, given some of the strength in inflation. The fact that we've had 3 CPI prints this year, a surprise to the upside. I do think that the Fed has to be a bit prudent here before they start cutting. They need to get confidence that the direction and trajectory of inflation is actually heading in the right way.
Well, another aspect of that new normal we talk about, though, is you're now competing against institutions if you're a new homeowner. And that's a world we really haven't seen before. So maybe cutting short-term rates doesn't really affect long-term mortgages that much. It might affect the attractiveness for institutional investors to come in more aggressively. So it may cause unintended consequences, as you mentioned earlier.
Yeah.
There's another issue with all this too, and that is that the Fed's fighting using its one tool, primary tool, interest rates, but what are they fighting? They're fighting the pent-up aftermath of the COVID supply chain dislocations, but they're also fighting fiscal stimulus, which really hasn't come off since the early pandemic years. And so essentially this fiscal impulse, which is still biased towards accommodation, is in a way its own headwind against Fed policy. And so I think ultimately what has to resolve in here is that there's some combination of the two is probably what's key to getting inflation down more materially and beginning to introduce legislation that actually supports, whether it's new housing development or other forms of activity, to take some pressure off of that lower end consumer.
Yeah. Well,
yeah, I think that's a point that we've been focused on a lot as well. One part of the argument is monetary policy. You can make the case that it's restrictive, but if you look at the residual fiscal tailwind, it's very strong. Essentially, the government is running a deficit of around 6% plus up against a full employment economy. That is a massive deficit. Typically what you see is that fiscal balances and the unemployment rate move together. As the unemployment rate goes higher, fiscal deficits go higher. It is very atypical to have a 6% deficit with a sub 4% unemployment rate. So that's one of the things that needs to be controlled. That's supporting the consumer, and that's something that's keeping the economy more robust than it otherwise would be.
right. Well, you better hope you don't get a downturn in the labor market. I mean, there's really no more tools in the toolbox if that's the case.
Yeah, no.
And the economy is predicated on how healthy the consumer is and how they can service their own debt. But I mean, from a fiscal perspective, you have to service that debt as well, which is so there's certainly an interest there in terms of bringing rates down.
Yeah, we take that down a little bit different path. When we look at, we call it the supply of equity or the de-equitization effect, where when you look at what's happening in the S&P 500 right now is that the free cash flow generation is really astounding, led by the mega cap growth cohort, but broader than that. And the effect is that you're starting to see this share repurchase activity get to a point where on a net basis, we think you're going to continue to see the net share count for the S&P come down by about 1% a year, which puts equities in a fairly favorable position versus fixed income, where I don't think we're going to see supply treasuries coming down anytime soon.
Yeah.
You've also seen listings come down. There's a lot less listings, and share buybacks are certainly a way to combat a slowing economy.
Yeah.
So when you think about positioning in this environment, oh, by the way, we're going into an election year, well, we are in an election year, Mark. I'm sure that's going to, we'll start to see some of that volatility creep into the market as well. So when you think about positioning, where are you allocating capital?
Yeah, I think the low-hanging fruit, frankly, has been picked for the S&P 500. So if you're looking at the broad market indexes, I mean, we're up at about 9% year to date. That's probably a lot of what you can expect over this kind of intermediate term period, as people are kind of waiting, they're uncertain around the election. Now, historically, the fourth quarter, including the month before the election, tends to be very good. So I don't see any reason why that historical pattern wouldn't hold true. But the thing that we're looking at within that Mag 7 is the earnings convergence between the Mag 7 and the rest of the market comes in the third and fourth quarter. So we think positioning-wise, the risk reward in the non-large cap tech names is more attractive because the valuations are less than half. The performance gap is at a level we haven't seen really since '02. So we see this kind of democratization, as I mentioned earlier, being the primary force in the next, let's say the remainder of the year in positioning. The other thing that we're counseling against is emotions are going to be high frankly. There's a lot of emotion currently. That's not going to get better between now and November. So the tendency is to overreact given your own view of the world. Historically, that has not been the right answer.
Anthony, what about from a fixed income perspective?
Yeah, from a fixed income perspective, we look at corporate credit, and you have really a disparity here. You have basically spreads near historical tights, but you have all-in yields that look very attractive. And if we look at just price action and investor activity for the last 12 to 18 months, investors are telling you that they're not necessarily concerned with the fact that spreads are so tight. They're more enamored by the fact that all-in yields are attractive. So at least in the short term, for the next 3 or so months, we think that corporate credit, particularly investment-grade corporate credit, is a good place to hide. However, we do expect some volatility to be reintroduced in the second half of the year because of geopolitical concerns, because of the election, things along those lines. Now, we are advocating in more flexible portfolios for securitized credit as well. So when you juxtapose the fact that corporate credit valuations are so tight, we do think that securitized credit makes sense, particularly top of the stack ABS and CLOs as well. On the rates front, I know we've been in an environment where inverted yield curve for a protracted period of time. We do think that it's starting to make sense to lag into steepeners. We think that steepeners make sense because it hedges you against the fact that the economy might start to slow down here and you could expect more rate cuts being priced in. But it also hedges you against the fact if inflation remains stubborn here and term premium needs to be rebuilt in the long end of the curve. So those are some of the themes that we're playing so far.
And John, one of those themes is active management.
It is, it is, and it's, you know, particularly in the fixed income market. First of all, the Fed basically said that they're done. If the data comes in against that, then they potentially could increase rates, but we're probably at peak rates at this point. That being said, if you look at a lot of the ETFs that are in the market in the fixed income space, they're index-based. Some of the indexes like the AG it's a rather inefficient index. My firm has a lot of portfolio managers that have deep knowledge of the market. And if you look at ETFs, ETFs actually are a price discovery mechanism for the underlying bond market. So the underlying bond market often doesn't trade. The stock price will trade more often than the NAV. So the stock price becomes the clarity in terms of marking the prices. Having an active manager within fixed income, identifying specific securities makes a lot of sense, because if you think about how baskets are created in the first place, they're just representations of the index. It's not like equities where you can find the exact equity. You're finding something similar. Active management kind of takes away that issue, and you can find securities that fit your mandate. So we are a big believer, obviously, in active management, particularly in the fixed income space as well as equities.
And Scott, you're taking a barbell approach to this.
Yeah, so the way we've been approaching this since last summer is that we've been of a view that we're going to get earnings broadening as we go into 2024 off of 23, and it's really kind of premised on the way the sector setups go. And we felt that earnings broadening would eventually lead to performance broadening. So our stance, going back to last fall, has been barbell. We want to own and be long growth, and we want to barbell it with cyclicals. We felt that we were too far along down the Fed path to play defensive, so we'd rather get to a positioning via cyclicals that sets us up for the other side of this period of Fed hawkish. What's happening as we go into Q2 on the heels of the strong performance off the November lows is that we're now starting to evolve our thinking, and we want to begin to allow for exposures that should more directly benefit from that eventual Fed pivot. City House view is it's coming in July. Maybe it's a little bit sooner, maybe later. But I think we're still looking at this peaking in Fed funds rate as a driver of what could be a shift down those parts of the market that presumably benefit more directly from some interest rate relief. That's going to be consumer, it's going to be utilities, it's going to be real estate to a certain degree. It's still banks, it's probably even autos. So you begin to shift your portfolio away from a traditional growth cyclical to something that has a more defensive characteristic, but it's not about being defensive. It's about being in the line of sight for where you ultimately should feel some interest rate relief.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.